Hello, class. This lecture is going to focus on what are the important points in securing an investment from an institutional investor or someone like a venture capitalist. So they look for certain things. And if you're starting a business and you're out trying to raise capital, it's important that you understand what they look for. And so there's several really important topics I'm going to discuss here today. This is kind of a long one, so bear with me. Watch it in pieces if you like. But these are some really, really important factors. And you got to think about these in any type of project. So what I mean by that is whether you're raising money from a venture capitalist or whether you're making a proposal to your boss, you got to understand what are the key important factors that move the needle for them, and then make sure you address them. And so this is also true in your project, in your improved customer experience project. You got to think through what's going to be important to the president of the grocery chain and what factors are they going to really focus in on, and you have to make sure you address those. So in this talk, we're going to focus about what venture capitalists look for and what are their important factors in making their decision points. So let's get on to the first slide. So here's one important thing I want to talk about. When you're raising money, whether it be from angels or from venture capitalists, from anyone, you want to raise a sufficient enough amount of capital to bring your company to the next major inflection point in value. So here's what I mean by that. If you think about a company, it sort of has major milestones that happen. Some of those milestones could be like if you're working on some technology, you get the technology to work. Or can you produce your product or service in reliable quantities, right? Can you meet production demand? Or are customers actually willing to buy it? These are various different sort of things that happen. They're events in the life of a company that when they happen, they fundamentally, number one, say the company is less risky than it was before, and number two, the company is worth more now than it was before. So you want to make sure you raise enough capital to get you to one of these inflection points. Why? Because it will make raising money later on much easier. So if you raise money and you don't get to making your technology work, then you have to go raise some more money. And the folks are looking at this and going, well, you raised money, you didn't get to where you wanted to get, so why should I give you money? And more importantly, when these milestones happen in the life of the company, the fundamental value of the company goes up, which means if you're raising equity, which is sort of what we're talking about here, you're fundamentally selling your shares of stock for a higher price, which is what you want to do, right? You want to sell your shares at a higher price, which means you, the founder, can get to keep a larger percentage of your company. You have to sell fewer shares to raise a specific amount of money. So this is really important. Think about what are the major inflection points in my business? What milestones can I reach? And let me make sure I raise enough money to get to that big next milestone. Another thing that I'll say that investors look for, and the thing I just talked about in the previous slide, this raising to the next inflection point, investors look for that too, particularly venture capitalists, because they want to demonstrate the increased value of the company. So they want to get that company to the same point. So that's one thing they look for, and you should look for just as well. Now here's two more things. Successful businesses change the playing field by doing at least one of the following. So they meet a current customer demand, 10 times or better. And what do I mean by that? So you have to think about it this way. If you're going to come out with a product that competes with an existing product, you got to think that that company is already working on a newer version of that product that's going to be 20 or 30% better or 20 or 30% cheaper than the product that's already out there. So if you come out with a product that's 20 or 30% cheaper, it's a ho-hum. Customers are probably not going to change. So you really need to think about coming out with products or services that are 10 times better than what's out there. Making something 5 or 10 or 15 or 20% better may work, but it's going to be a challenge. So that's one sort of tactic that you can look at. Another one is convincing the customer that they have a new need. So what do I mean by that? Well, I'm going to go through some examples in the following slides that'll actually go through each one of these 3 points here, and to hopefully better understand, for you to understand that. But oftentimes customers don't realize, I didn't know I needed an iPod. I didn't know I needed an iPhone, right? But lo and behold, I certainly did. So oftentimes those are types of products too that do very well in the marketplace. The third sort of category, as I think about products, is making products accessible to a whole new set of customers. So what do I mean by that? So think about the, I forget the name of it, but there's a cell phone that's really targeted towards seniors. It's got big buttons on it. It's really simple to use, right? So this folks who develop that product are introducing this product because they want to sell this to senior citizens whose eyesight is bad. They can't look at a screen. They got to look at big buttons. And again, I'll have another example of this in the following slides. So it sort of falls into one of these 3 categories, as I like to think about it. And every company that's successful at this has a strategy to accomplish this. It's not happenstance. It's something that they're working on, they think about, and that's how they build their business. So these are really important points that sort of serve as a backdrop to what I'm going to talk about here in the following slides. So this is an interesting story. The picture on the left, this is what copy machines used to look like in the 1970s. They were big, they were elaborate, they cost $750,000, and they were in a central location within an organization. So at that time I worked for General Electric, and there was a copy center. It was a room you went to if you needed copies of something, and you dropped off your 5 pages of originals through this little window with a little cover page, and you left it there, and you can come back 4 hours later and you'd have your copies. And these fancy machines, you know, folded, stapled, collated, did all that stuff, double-sided, etc. And they cost a lot of money. And Xerox was in that business. They built their whole business around that. And then in the late 70s, IBM and Kodak also got into the copier business. And those 3 companies were going head to head. And you know, Xerox's machine would do 60 copies a minute, and then IBM would introduce a new machine that did 65 copies a minute, and then Kodak would introduce one that did 70 copies a minute. And so there was the copy per minute race was on. And these machines were big, expensive, and it took a long time to get copies. If I needed, you know, 20 sets of something to hand out for a meeting, I had to go down there 4 hours in advance to get it. Which isn't necessarily a bad thing, but there wasn't this instant turnaround. So then what happened was this company called Canon comes out with one of these. And it's a little desktop copier. And it uses coated paper. It's really slow. It made like 1 copy a minute. You had to open the lid. You had to put the piece of paper face down. You had to close the lid, push the copy button. So it was really slow and really sort of not very effective. Sold for $900 when it first came out. And I remember working at GE, and I remember going to at that time they're called secretaries, now assistants, and I said to Helen, I need 5 copies of this 1 page. Can you get those done for me? And she goes, yep, I'll take care of it. But you know, Gertrude down the hallway has one of these desktop copiers, and if we had one of those, I could make the copies right here for you now. And I said, oh, how did she get that? How did Gertrude get that copier? She said, oh, her boss bought it for her. And so I said, oh, okay, well, being a good boss, then I said, we should buy one too. So we bought a copier. And for that niche market, i.e. you need something quick, quality doesn't have to be great, right? These Xerox copiers, the copy quality was fabulous, right? If you had a schmutz on the original, it sort of removed the schmutz somehow. And these Canon copiers were slow, the coated paper was expensive, copies weren't great, but hey, if you needed something quick, it worked. So it was interesting in that a couple of key points I want to make here. What Canon did, I think, was very clever. Number one, everyone always think about the IBM, Kodak, Xerox rat race for entering the big marketplace, right? That's where those big companies went at it, and they were beating each other up. So what Canon did was they came in much below the market. They came in with a product that sold for $900 instead of $750,000. So the point here is oftentimes if you introduce a product with a big enough price differential, customers are willing to compromise on performance. We always think about coming out with products that are better than the competition, but oftentimes there's opportunities where you can come out with a product that is much, much, much cheaper, and it may not have the performance, but people are willing to do that. There's lots of examples of this. So with this copier, the other important point was they priced it at $900. And the reason why is, as a department manager in corporate America in the 1970s, usually the department manager could approve a purchase order for up to $1,000 without having to get any other approvals. So by pricing it at 900, they knew that I, the department manager, could make this decision. Because if it was priced above that, I'd have to get approval from my boss, and he'd go, well, wait a minute, we already have a copy center, right? Why do we want to buy this? And the person who runs the copy center, right? There used to be a vice president of copier services. He would say, whoa, 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 that's my domain. You can't buy copiers. But by pricing it, number one, at a point where the decision maker can make the decision, the user, the decision maker, that's important. So think about two things in this slide. Number one, oftentimes, if there's a large enough price differential, customers are willing to compromise on performance. And number two, understand where the decision maker is who's going to make the purchase. And if that decision maker has the authority to make the purchase, or are they going to have to go get someone's approval? So those are two really important points in this example that I want you to think about when it comes to starting an entrepreneurial business with products and services. Let's go to the next slide. Okay, think about this. Think about bottled water. Your competition's free, right? You can get water for free from the faucet. So how do you convince people to get bottled water? Yeah, there's the convenience factor, etc. But jeepers. Think about when this was starting. It's a little different today. It's a well-established market, but think about in the early days. So what do you need to do to convince people that they need bottled water? Well, you probably need to launch a pretty large marketing and sales campaign to, number one, convince people they need something they didn't realize they needed. So what does that mean for your business? Well, think about these bottles of water. They cost, let's say, $2 a bottle. That's pretty expensive for water. Now think about it. Probably what's inside the bottle costs 5 cents, and maybe the bottle and shipping costs 10 cents. So you got a cost of goods of 15 cents. So you're making like $1.85 on each one of these bottles of water. So by charging $2 a bottle, you're making a ton of money, but I bet you they're spending $1.50 of that on promotion and advertising, because they got to convince you that you need this bottled water. So that's why I think when you think about these things, you have to think about the customers you're going after. Because the point here is, if they would charge 30 cents per bottle of water, 15 cents is left over after the cost, they really wouldn't have much money to spend on advertising and promotion. And I don't think you'd have a successful business. So you have to take into account and consideration the fact that sometimes you're going to have to spend lots and lots of dollars on excuse me, you're going to have to spend lots and lots of dollars convincing your customers that they have a need, particularly if you're introducing product into a new market segment. This is often the case. You have to do missionary work to convince customers they need your product. So you have to make sure you price it properly so that you have enough margin left over to do that advertising and promotion in this case. Oftentimes, lots of young companies price their product the following way. They say, okay, it cost me 15 cents for fill up this bottle of water. I'm going to double that, and I'm going to charge 30 cents. And yeah, that makes logical sense in some cases, but not in a situation where you're introducing a new segment or a new product, and you have to convince the market it has that need. So here again, thinking about pricing strategy is really important, and what you're going to have to do with that money to convince your customers and get your customers. Okay, let's go on to the next point. Oh, let's take a look at Dell Computer. This is really about making your products available to a whole new segment of customers, a little bit similar to the Xerox example, but with a slightly different twist. So if you remember when Dell Computer started, they sold direct. So they were mail order. And prior to that, or during that time, the way you bought a computer is you went to a store called Computer Land or Computer World, and these were big retail stores. And there you could go pick out your computer, and they would load the software on it. They would match it up with a good display and a keyboard, and they'd get all your applications loaded, and you'd come back the following day, and you'd pick it up, and you'd take it home, and you'd lay it out in your office, and you couldn't figure out which cable plugged into what because they all looked the same to you. And you turned it on, and it didn't necessarily work. So it was a real challenge, and very few people knew how to do that. So you had to have these retail stores that provided that expertise in setup and delivery of computers. And Dell started their business by selling direct. And so what does that mean? What does their customer look like? Well, their customer are basically just computer geeks who understand how to do this stuff. And they can load the software on because they like doing it and they know how to do it and they enjoy doing it. The challenge is, of course, is that that market is not very big. So as Dell wanted to grow, they had to figure out how to make their products accessible to people other than computer nerds. And so what did they have to do? Well, if you remember, Dell is the first company that sort of came out with preloaded software. They had the absolute best website for helping you configure and order your systems. They also were the folks who came up with this notion of colored cables plugging into the same colored connectors. So they did a lot of stuff to make it easy for when the UPS guy dropped off that computer for you to then take that computer, plug it together, plug it into the wall, hit the on switch, and voila, up it comes. So they were the first to do that. So how come they could do that and the other folks couldn't do that? Well, number one, Dell had to because they were selling direct, and if they wanted to grow their market, they had no choice. But think about this. When you're selling direct, what does that mean? If you sell your product for $1,000 direct to the customer, that means you got all $1,000. All of the other manufacturers were selling through retail outlets. And typically the markup on a retail outlet, if you're selling for something for $1,000, the manufacturer is probably getting somewhere between 500 to 750 of that. So let's just say they're getting 750. It goes to the manufacturer, 250 goes to the retailer. Well, here Dell is getting $250 more for every computer they're selling. So they can spend time and energy and resources and development and thinking about, hey, how can we make this accessible to more customers? How can we install these systems easier? How can we make the turning them on easier? How can we preload software? How can we do all these things? So that was Dell's strategy. They realized that they had to, if they're going to sell direct, they had to do this to make their products accessible. Now, of course, the challenging part here is that's not a thing that lasts forever. Now, that's the way all computers are sold. And computer land and computer world are gone, long gone, and they don't exist anymore. Uh, but Dell really built a wonderful business, and as I like to say, it made it possible for my dad to buy a computer. And prior to that, whenever he bought a computer or got some new software, he called me up, and I'd come over, and I was the geek. I'd have to do that for him. And very same thing with the iPod and iTunes. Prior to that, it was very difficult to, if you bought a CD, to load that music onto your player. And when iTunes came out, it basically made it possible for you to buy it, and somehow magically it appeared on your iPod. And I remember got my dad one of those, so I didn't have to go over there and take his CD and rip it and copy it and install it on his iPod. He just clicked it on iTunes, and away it went. So this is all about making products available to a whole new set of customers. So again, a great approach and something to think about when you're starting a business. Okay, here's the last one we're going to talk about, and this is Kia. So when Kia came on the marketplace, I think at that time you could buy a Honda Civic um, or a Toyota for about 20 grand. And the Kia sold, I think it was for like 18.5. So $1,500 savings. So that's pretty not bad, pretty significant. And the challenge was it wasn't really selling. So think about it this way. Besides your house or your condo, the car is probably the biggest investment you make. So for 20,000 bucks, you can buy a Honda or Toyota or Chevy. They're reliable and they're good. Or you can buy this brand new product, brand new brand that you don't really know much about. You can save 1,500 bucks, but geez, if it doesn't work out, I'm screwed. So it's a pretty big risk. So customers were not really willing to take that risk. So what did Kia do to address that customer risk? They're the ones who introduced a 10-year, 100,000 mile warranty. And at that time, Honda and Toyota were 2 years, 24,000 miles, and Mercedes, kind of the big reliable car in those days, they were just 3 years and 36,000 miles. So Kia basically blew the doors off the warranty and reliability piece. They just told people, hey, look, you buy our cars, you don't have to worry. 10 years, 100,000 miles. And now all of a sudden, that $1,500 price tag is a huge difference. Huge difference, right? Because now I actually have a better warranty than my Honda or even a Mercedes, and I'm saving 1,500 bucks. So their sales totally took off. So here again, they identified what the big customer risk is to buying their products, and they addressed that risk head on. They said customers are not going to buy because we're a new company, it's risky, we're not saving them enough money, it's a big purchase for them, so we got to come out with a better warranty. And you could say, well, why didn't they just match the warranty? Well, I guess they could have done that, or they could have gone to maybe the Mercedes warranty of 3 years, 36, but they came out 10 years, 100,000 miles. So they really, really differentiated themselves in the marketplace. And most people don't keep their car that long. So, folks are going, hey, this is great. And so it really, really changed the playing field for them. And it was a key strategic decision that they made. So let's try to summarize these points in the next slide. So here's some key points. Bottled water, right? You're convincing your customer they have a new need. And it's not about price, right? They did not make that about price. They made it about it's a new need and it's important and it's invaluable. And if you're charging $2 for something you can get for free, the stuff in the bottle for $2 must be better. It just has to be better. And so that's an interesting strategic thing as well. So Dell, a whole new set of customers, right? Getting my dad to be able to buy a computer. And Kia solved this huge customer risk, and by improving the warranty, basically almost by an order of magnitude, and really putting a stake in the ground. And the one that's not on here is the Canon copier, and that was number one about don't always think about making the product better. If you have a big enough price differential, customers are willing to compromise on performance. So that's another big, really important point. So I bring these examples out here to give you some context in thinking about entrepreneurial endeavors. You gotta have some key thing that's really going to drive the customers to want to buy your product or service, and you got to think about it strategically. And so that's why I give you these examples to sort of hopefully expand your thinking a little bit about different ways of doing this. So this would be a good time to take a break if you want to. The talk's going to take a little pause here, and if you need to take a break, go right ahead, and then we'll dive into the next slide. Welcome back. All right, killer assumptions. And what the heck's a killer assumption? Well, every business has one, and the reason I call it a killer assumption is if this assumption doesn't come true, you're dead as a business. So in Kia's case, what was the killer assumption? The killer assumption was that the 10-year, 100,000-mile warranty will remove all of the customer risk, and they'll have enough confidence that that $1,500 savings will be significant and customers will buy our products. That was their killer assumption. Really important. Kenneth's killer assumption was, hey, if we price this at $900, we think that department managers will want to have one of these on their desk for the convenience of it. So think about what your killer assumption is in your business and focus on that. So I remember this presentation that I once, a company gave to us when I was full-time in the venture business. And they had a new protein that they said helped to stop the growth of certain types of cancers. So, I mean, this is really big, right? I mean, if you do something like this, this is monumental. And so they went through their talk, and they spent 80% of the talk explaining to us how big the cancer market was and how much money there can be made. And they spent about 10% of the talk talking about the data they had and supporting evidence they had to say that their drug actually stopped the growth of cancer. So think about it this way. Where's the risk in this business? The risk is not in the market. We know the market is going to happen. The risk is, does the damn product work or not? So their talk was totally flip-flopped. They should have spent 80% going through the data to convince us that they had a product that was going to work, because I'll give them the market. And you can think about businesses as there's sort of three big risks, right? There's product risk, there's market risk, and then there's team risk. There's also a fourth one, finance risk. So product mix, does the darn thing work or not? And if that's a big question, when you're pitching this and talking to people, you better take people through how you're going to do that. Another one might be market risk. Are people going to buy it? I mean, I don't know if they're going to buy bottled water, but here's what we're doing to address it. Here's the risk, and here's how we're going to address it. You identify the risk, you address it. Team is, does the team, the people running this business, have the right skills to take it through? And then are you going to be able to raise enough money? And some things, as you can imagine, require lots and lots of money. Other types of businesses require less. So if you think about risk in these kind of four different categories, figure out which one or which ones are the real showstoppers and make sure you address those. So really, really focus in on those. And make sure your assumptions are minimal and you have lots and lots of facts. So if you know what your killer assumption is, then put together your facts to address that. And oftentimes, listen to your customers. This is one thing that a lot of companies don't do. And I'll tell you, in the first company I started, we made a big mistake. We didn't go talk to customers early in the process, and it cost us dearly. We went out of business. The first time we actually talked to a potential customer was at a trade show when we were exhibiting our products, which by then it was a bit too late because the product had already been designed. So make sure you keep engage with your customers or your potential customers early on in the process. Okay, let's go to the next slide. So we're going to talk a little bit about risk here. And by risk here, I mean investment risk. The risk that the venture capitalist or investor is taking in your company. And this should help you understand why they look for some of the things they look for. And we'll have a better understanding of this when we talk about term sheets later. But this is really important. So if you're in the venture capital business and you're making seed stage investments, which are companies that are just starting, you got to figure 6 out of 10 of those are going to fail. Holy smokes, that's a lot. So if I have $10 million to invest, and I invest $1 million in 10 different companies, 6 of those are going to go out of business. So I've invested 10 million and I've already lost 6. So I only have 4 million left, right? I have 4 million, I have 4 $1 million investments in 4 remaining companies because the other 6 have gone out of business. So if I just get back 2 times my money out of these 4 investments that are left, I'm only getting $8 million back. I lost $2 million, right? I invested 10. I invested $1 million in 10 separate companies. 6 of those went out of business. That means I had 4 companies left. 4 of those companies got sold for twice that amount of money. I got back a total of $8 million. I lost $2 million. So I got to get back probably 10 times my money, or at least think I can get back 10 times my money in each of those businesses, or maybe 5, right? Because if I get back 5 times my money, so I would have made, if I get 5x return, then I would have made 20 million bucks for a net gain of 10 because I invested 10. So 20 minus 10 is $20 million. I doubled my money. And so that's why VCs, particularly seed stage VCs, when they look at your business, they're looking at, can I make 10 times my money in this business? As your business grows, becomes more mature, has sales, is larger, has revenues, has employees, have manufacturing plants, etc., the risk goes down. So here in a late stage company, only 1 out of 10 is going to fail. So use the same scenario. If I have make 10 $1 million investments in a late stage company, 1 of those will go out of business. So I have 9 left. And let's say I doubled my money in those. I'd end up with 18 million bucks. Pretty low risk. And all I need to do is double. So a late stage VC can say, you know what, if you can just show me a path to doubling my money, I'm happy with that. I only need to make 2 times my money because I know only 1 out of 10 of these are going to go out of business. But in the seed stage company, 6 out of 10 are going to go out of business. So that's why early stage, seed stage VCs really look for high returns because they know they're going to have a lot of zeros in their portfolio. So this also is very important to understand conceptually because it plays an important role in how VCs look at making investments in companies. Okay, so now I'm going to take you through some points that I think are important when you're making a presentation to a potential investor. And the way I like to say this is how to explain your business to your grandmother and raise money. And I'm not insulting anyone's grandmother here, but you got to make it simple. Us VCs are not all that smart, and you got to be able to explain your business in a way that's understandable. As soon as you pick up the chalk and start writing differential equations on the board to explain how your business works, you're going to lose everyone in the room. There will be at some point in time where you'll need to do that, but certainly not in the first presentation. So here are some key points that we're going to go through that I think are important and that you should consider when you think about making your presentation. Again, whether it be to start a business or you're starting a new project or a new proposal in your existing firm. I think these are some important points and elements. So let's dive in. So I like to think about it like a story. You got to tell a story. It's not just a set of slides. Um, I think a story is really important here. A story is what gets people's interest. It gets them sitting on the edge of their seat, and you got to think about it like a novel, not a documentary. Jacques Cousteau makes documentaries. I would much rather read a novel. A novel has a storyline. It's fundamentally based on fact, um, and it has a lot of intriguing things in it. A documentary sometimes can be dull and dry. So think about, how do I tell the story of my business? How can I get people interested in this? What are the things that are going to suck them in to get them to say, hey, that's really neat? So that's why I think about it like a story. And like a good story, it has several different parts. And let's dive into some of those parts. So here's what I think are the key parts of your business story. One is the product. What is the product? You got to be able to talk about the product. And by product, that could be a product, it could be a physical widget, or it could be a service. Either one. I use those words interchangeably here. Um, so it's not about the technology. Oftentimes, people get hung up on what's the tech, what's the tech, what's the tech. Uh, it's not about the technology. It's about the product. It's not about your idea. It's the product. In other words, at the end of the day, what are you going to put into a box that the UPS driver is going to pick up and deliver to your customer? You got to be able to articulate that really, really clearly. What is it that you're actually selling? What product or service? What problem are you solving for your customer? Right? In other words, why are they going to buy it? If you're not solving a problem for them, they don't care. And more than likely, they're already doing it somehow. Right? Back in the Canon example, we were already making copies. It took 4 hours, but we were already making them. So we had a way of making copies. But you gave us a way to make them within a minute or two as opposed to 4 hours. You think, oh, a minute per copy is really slow. That's true. But when it's a minute versus 4 hours, all of a sudden it sounds pretty fast. So you got to be able to figure out what problem you're solving for your customer. You should, these things here should be very crystal clear in your mind. And you should be able to articulate them very clearly in your story, in your novel. Another big element is the market. How many of these things can you sell? And I always think about this as you got to go bottoms up, not top down. I see a lot of these presentations where people go top down. So they say, hey, there's 400 billion people in the world. They're all potential customers. We have no competition, and we're going to sell lower than anybody else. So first of all, not all 400 billion people in the world are interested in your product or service. You better clearly identify who is. And I'd much rather have you say, you know what, our product or service is for IT managers in Fortune 1000 companies, and that's our target. So that's really good, right? You have 1,000 potential customers that you're going to be able to sell this to, and that's your target. So you know exactly who to phone call. You know exactly who to meet with. When you have 400 billion, you don't know what to do. You don't know who to talk to. So identifying your customers as narrow as possible is really important. You always have competition. Yes, indeed, nobody made a copier just like Canon, but their competition was Xerox, Kodak, and IBM because that's how people were making copies. Just like you could say, well, Henry Ford didn't have any competition. There was no other car. Well, sure, he didn't. There was no other car, but there was a horse, there was a buggy, there was bicycles, there was shoe leather. So he did have competition for people getting from point A to point B. And lowest selling price, you know, I this is a tough one. You say, well, we can we can sell at a lower price because we're a small company, we have low overhead, etc. Well, hopefully I want you to be a big company. So then that price advantage is going to go away. Now, if you can sell at a lower price because you've invented a new way of manufacturing a product or service, then that's good. Then you can compete on that. But that's because you have an intrinsic new way of making or delivering your product or service. So again, zero in on what your customer looks like. What are the characteristics of your customer? You should be able to describe a typical customer. Who are the first 5 people you're going to call? If you can't identify the first 5 people you're going to call to try to sell your product to, you don't know who your customer is. Understand what's going on in the marketplace, who's your competition, and they're going to react. When you do something, they're going to react. What Xerox and Kodak did when Canon came out with that copier was they said, oh, that's just a toy. That's not a real copier. It doesn't collate. It doesn't staple. It doesn't fold. You have to manually feed things. Come on, who would ever want to buy one of those? And the person who ran the copier center didn't want to buy one. You're right. But the individual departments all did. So your competition is going to do something. At a minimum, they're going to badmouth you. But they can lower their price too, right? So if you're selling light bulbs and GE sells light bulbs for $1 a piece, and you're going to say, hey, I'm going to come out in the marketplace and sell them for 95 cents a piece, GE can lower their price to 95 cents for 6 months and you're out of business. So think about all the different things about what competition can do as well. So this is really important to understand the market. It's another key element of your story. Another big piece is the team. So who are the people who are starting this business? Who are the people who are running it? And I know you're really smart, but chances are you're not really smarter than everyone else. And what I want to know about is not your life history, but what are the team's relevant experience? What do I mean by relevant experience? Well, if the 3 of you worked together prior at another company, that would be relevant experience. You know each other. You've worked together before. If you worked in a similar industry than to the one that you're starting your business in, that's relevant experience. It's also important to know who's going to be the boss. You can't say, all 3 of us are going to make decisions together all the time. At some point, that doesn't work. Don't confuse how you divide up the ownership of the company. You could divide up the ownership of the company a third, a third, a third. But an investor is going to want to know who is the boss, who's going to make the decisions. So make sure you're clear about that. And all of you have a clear understanding of that. Also, clearly identify what draft picks you need. What skills are you missing in your company? What skills are you going to have to bring in because they don't exist between you and your other 2 co-founders? So identifying those elements are really important. So remember earlier I said there's the technology risk, there's the market risk, and the team risk, and of course there's the financing risk as well. So we've just kind of gone through those. Those are the key chapters in your story, in your book, and how you're addressing them, each one of them. And this is the last piece, the financials, right? You have to have some financial pro forma. And don't say in 5 years you're going to be a $2 billion a year company. That happens very, very, very rarely. And again, you're going to have better gross margins than anyone else. Your costs are probably going to be very similar to everyone else's, unless you've invented a new way of manufacturing or producing something. But think about how fast you can really grow. Now, here's the interesting thing about financial projections. Everyone knows they're not real. Everyone knows that's not actually what's going to happen. So the important point here is just all you have to do is make them believable. They just have to be believable. I know when I read those, that's not actually what's going to happen. You know when you did it, that's not actually what's going to happen. But you got to make them believable. So you got to convince me that what you have here is a possibility and it can actually happen and work. And that's the most important element of the financials. If you tell me you're going to be a $2 billion a year company and Google's going to buy you for $16 billion, that's such an outlier in the normal world. It's not believable. It may happen, but it's a super long shot. Chances are you'll be a $50 million a year business and someone will buy you for $150 million. That's a much more believable story. So the financials are important. You got to have them, but make them believable. That's the most important thing. Now, one really, really important point to remember is when you're raising capital, what you're selling is your company. It's not the product. You're selling the company. So you need to make the whole company attractive, not just the product or your invention or your service. So that's just an important point that I want you to think about too, right? When you're selling, when you're raising capital, you're selling your company. And so you really gotta think about how to tell that story in the context that's going to make someone excited about it and give confidence that it will be successful. Because in order to have a successful business, a lot of pieces have to fall together. There's both the product or the service, there's the market, there's the team. You got to have enough capital to build the business. So all of those things play an important role in this. So really important factor to remember this. Let's go to the next slide. This goes back to your financial projections, right? We all think about a hockey stick curve, and everybody talks about companies that are going to grow like a hockey stick. And so here's my hockey stick slide, and I think it's what we all want and desire. However, let me just show you the next slide, which is a hockey stick slide. This is also a hockey stick, and it's much more closer to reality that happens. So everyone has those great charts and graphs of hockey sticks, but I just wanted to share that, yes, this too is a hockey stick. Okay, enough of the hockey stick humor. I'm going to take you through an example now. This is a financial example of you and your partner starting a company. So on day one, you start your company. There's two of you. You each own 50% of the company. And you raise $100,000 from friends and family. Remember we talked about friends and family as being a good source of capital in a previous lecture? And somehow you come up with this notion that the company's worth $500,000. So you and your partner, you know, both just graduated from Clarkson. You have degrees in engineering and an MBA. You're really smart. And you convinced your friends and family that it's worth $500,000, and because you've been working on it sort of in your dorm room or your apartment for the last 6 months, and you've got a little bit of work done on it, and you know your friends and family are kind to you, so they agree to the $500,000 valuation. So this is called a pre-money valuation, meaning it's before the money comes into the company. That's what pre-money means. So how do we figure out what 600, or how do we figure out what percentage of the company $100,000 buys? So it's the amount of money invested, which is $100,000, divided by the pre-money valuation plus the amount of money invested, which is 600,000. So it's 100,000 divided by 600,000, or 16%. So $100,000 by 16.6% actually of that company. And so now you own 41.7%, and your partner owns 41.7%, because again, it has to add up to 100%. And your friends and family consists of your Uncle George, who invested $25,000, and Grandpa Ralph, who invested $50,000, and your mom and dad invested $25,000 together. So that's how you raised that $100,000, and that's how it was broken down. And now the post-money valuation is $600,000. So post-money and pre-money are sort of private equity terms that you might hear, and so they're just important terms that I wanted to share with you. But that's sort of how that works out. So now you have $100,000 in the bank, and you go to work on your company, and you're trying to build it up. Let's see what happens. So you and your partner work real hard. You spend all that $100,000, and you start looking for more money. And now you want to raise $500,000, and you come up with a $3 million pre-money valuation, and you find a venture capitalist who says yes to the deal. So That's all good. So you're going to raise 500,000 at a 3 million pre, and let's take a look at how that shakes out. Okay, so now let's take a look at the ownership of the business. Sometimes also can be called the cap table. So that VC just put in 500 grand. Your mom and dad put in 25, grandpa put in 50, Uncle George put in 25. So on day one, you and your partner each owned 50% of the business, and then friends and family invested $100,000. And again, you can figure out what percentage their investment bought by taking the amount they invested, divided by the pre-money valuation plus the amount invested. That's how you can calculate the percentage ownership. And then this VC who invested $500,000 at a $3 million pre-money valuation ends up buying 14.3% of the company. Pretty simple arithmetic, but it's important to understand how this works. Okay, let's keep going. You and your team keep working really hard. Now you're looking to raise $3 million and an $8 million pre, and you find another VC that says okay to the deal. And let's see how that shakes out. So here, it's $3 million at an $8 million pre, and you can see how the ownership is shifting. So this last VC bought 27% of the company. You can do the arithmetic if you want, but you can see your ownership has gone from 50% down to 26%. And your parents and Uncle George and Grandpa Ralph and VC1 too, their ownership has gone down. This is called being diluted. So, because again, it has to add up to 100%. So if a new investor is buying 27% of the company, it has to come from somewhere, and it comes from the existing shareholders. Now, sometimes what will happen is, let's say, in this case it didn't, but let's say it could, that this VC wanted to maintain their 14.3% ownership. So they could do that by either by contributing to this $3 million. So I didn't do the math here, but they may, in order to keep their 14%, they may have to kick in 200,000 of that 3 million, and then their percentage ownership would stay the same, and VC2 would own a little bit less ownership. So that's sort of anti-dilution, or a way that you can protect your position in a company. But this is called dilution, sort of this general progression of owning less and less as other people invest. Very normal, happens all the time. So that's pretty good. Now, being a good owner, founder, you send a nice letter out to all your investors, and you send a letter out to your friends and family saying, hey, we just took in this $3 million investment and an $8 million pre. So what would the post-money valuation be here? The post-money would be the pre plus the amount invested, or in this case, that would be $11 million is the post-money valuation. So you write a letter and say, hey, our company's now valued at $11 million. And Grandpa Ralph calls you back and says, hey, Sonny, that's really nice, but I want my money. Where's my piece of that? Because my ownership has gone from 8.3% to 5.2%. What's going on? And you say, well, Grandpa, you used to own 8.3% of a company that was worth $600,000. Now you own 5.2% of a company that's worth $11 million. So Grandpa says, hey, that's great. Send me the money. Well, the problem is this is non-liquid, right? The amount of money that this VC invested went into the bank account of the company to be used to fuel the growth of that company. The VC did not make that investment to put money in the pocket of the previous shareholders. So that's another thing you sort of have to remember here, is that when VCs invest, they want that money to go to work to grow the business. They don't want that money to go into the pocket of a previous shareholder. So you tell Grandpa, hey, be patient, Grandpa. This is a non-liquid investment right now. Hopefully we'll sell the company at some point, and then you will make your money. Okay, we keep going. You keep working, and then you're going to work a $7 million raise at a $13 million pre. You find another VC that says yes, and the cap table looks like this now. The pre-money valuation at this round was 13 million. They invested 7 million. So the post is now what? That'd be 20 million, right? So pretty nice valuation. And there's how the ownership works out. And you can see you've gone from owning half the company down to just under 17%. So let's see what happens next. So your phone rings and it's Bill Gates, and he says, hey, we want to buy your business. And they offer you $45 million for the company, and your board of directors says, yes, we accept that offer. So that's all good. And so what percentage of the company does the $45 million buy? Well, it's not a trick question. It buys 100% because Microsoft wants to buy your whole company. So what's the pre-money valuation in this case? It's 45 million, and the post money is 45 million, because this money is not going into the bank account of the company. It's going to all the shareholders, because Microsoft is buying those shares of stock that are owned by you, grandpa, your uncle, VC1, VC2, VC3, right? So here, the company is being bought, and they're buying those shares of stock that are already existing. So that's what's a little bit different here than the other investments. So those investments, the money goes into the company to grow the business. Here, the money's going to the shareholders. So let's take a look at how this shakes out. So Microsoft pays 45 million for the company, and you owned 16.9%. So you get 7.5 million bucks. Let's take a look at the VCs, right? Let's go back to what we talked about earlier, is that the first VC in takes the biggest risk, so they should probably need to make the biggest return. Let's see if that's the case here. So the first VC invested $500,000 and they made 3 million. So that's about a 6-to-1, 6x return. So not fabulous, but not bad. The second VC invested $3 million. The company was more mature, the risk was lower, and they made almost 8, so about a 2.2x. And the last VC, who knew that 9 out of 10 of these is gonna be fine, and they're gonna get their money back at plus more, they invested 7 million, and they got back 15, so about a 2.1x. So the risk reward ratio is pretty good here. The person who took the highest risk made the greatest amount of money. So think of your friends and family, right? They're the ones who took the real flyer on you and your business. Grandpa invested 50, and with that 50, he made 1.5 million. So that's a pretty big return. So with the $50,000 investment grandpa made and a $1.5 million return, he made 30 times his money, as did your mom and dad and Uncle George. So it all shakes out sort of like it makes sense, and as it should. But this is just sort of give you a feeling or an example of how this can work, and what the type of money that one can make. And this is a typical exit. Most companies get bought or sold for less than $100 million. The things that you read about in the paper when so-and-so gets acquired for $4 billion, the reason it's in the paper is because it's pretty unusual. So this is a very typical sort of scenario here that we've worked through today. So in this scenario, you and your partner each got 7.5 million bucks, and the investors in total got almost 30 million. So everyone is happy, everyone is pleased, and it's a great, great exit opportunity for everyone. So thanks for listening to this long one. I know it was kind of long, but just some real key important points here in telling your story, sort of understanding the arithmetic and the math and the finances and how it works, and making sure that you understand why customers are going to buy your product, and thinking through what the major customer risk is, what's going to prevent them from buying your product, and addressing that risk head on. So I hope this was helpful, and thanks for your attention, and hope you have a great day.